let's start the conversation with what came through from the FOMC, and it was really as scripted. So we could see a cut in September. What's next? How is the market interpreting this?
Well, I think it was slightly more than what the market was expecting. I think that the market was expecting him to say we're closer and kind of leave it at that. We're closer to feeling confident that the inflation is getting towards our target. But he seemed to invite speculation that they were going to move in September unless something very unexpected happened. And so it's not just opening the door, it's kind of saying I'm going to walk through it unless there's something that impedes me. So I think the market took it as a dovish signal. And quite possibly that if he was so convinced that, they should be moving in September, it suggests that, it's probably a sequence of cuts. And it's not, the sort of one and wait and see wasn't in the cards. It was, September, possibly November. Then you sort of say, well, it could be December as well.
Okay, if we're tracking cuts and how many and by what magnitude, we're also tracking the BOE today. What do you think is going to happen there? It's a very close call.
And it's a very close call in our minds as well. But we see on the margin a little bit more probability that they cut than that they hold. But the data have been genuinely mixed. Inflation has been coming down, but not monotonically. The activity indicators have been slowing, but not uniformly. There's a case to be made to cut, and we think that they'll kind of give a tentative cut, saying that it's good enough and we'll have to wait and see. But they could also say, we're not quite there and, point to the next meeting.
We were watching the Bank of Japan yesterday and raising rates, and they haven't closed the door. Ueda saying that he could make another hike as soon as this year. Other central banks are cutting. So with these interest rate differentials, what should we be keeping track of and what should we make note of?
Well, one thing I find that's very interesting, with the respect, given that the Fed was quite dovish and we saw U.S. equities pick up, global equities, with the exception of Japan, seem to be picking up. It still seems that some short yen cross positions may be getting unwound. If you look at the weakest performers, they tend to be high beta currencies that normally you would, and high interest rate currencies that normally you would expect to go up if market sentiment is positive. But I think that there were a lot of long high yield or short yen positions, and it looks like they're still getting unwound. So pressure on Aussie, pressure on MEX, pressure on South Africa. We'll probably have to wait a few days for those positions to really get cleaned up before they can take advantage of the better risk-on type of atmosphere that the market has.